Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Thursday, April 9th, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, there are several notable developments across the markets today. We're seeing significant movement in commodities with wheat prices rising amid concerns about the Iran ceasefire holding, and oil rebounding after what's been described as a shaky start to the truce. The Iran ceasefire situation is creating considerable volatility, and investors are clearly uncertain about whether this fragile agreement will hold. On the corporate side, we're seeing some interesting activity in the semiconductor space, with United Microelectronics seeing stock price increases ahead of their dividend payments and March sales numbers. Meanwhile, in the healthcare sector, Humana is experiencing upward momentum ahead of their earnings release. There's also been notable news from the private credit markets, where investors attempted to pull $20 billion from private credit funds in the first quarter, which signals some concern about liquidity in that space. Meta made headlines with a commitment to spend an additional $21 billion with CoreWeave as AI infrastructure costs continue climbing, which speaks to the massive capital requirements in the artificial intelligence build-out.
That's quite a range of developments. The Iran ceasefire situation seems particularly important for market stability. How are you reading the market's interpretation of these geopolitical risks?
The market reaction has been what I'd call cautiously optimistic but fragile. We saw an initial relief rally when the ceasefire was announced, but that enthusiasm is already fading as questions emerge about whether the agreement will actually hold. What's particularly telling is how oil markets are behaving. We're seeing US oil exports positioned to hit record levels as the Iran conflict has triggered what's being called a race for supplies. Britain is now the top destination for US jet fuel, which shows how global energy flows are being restructured. The dollar is showing some weakness, with the Financial Times running a piece about how the Iran war has exposed dollar vulnerabilities. For traders, this creates both opportunity and risk. The energy sector remains highly sensitive to any news out of the region, and we could see sharp moves in either direction depending on how the ceasefire holds up. I'm watching the Strait of Hormuz situation closely, as Britain is calling for it to remain toll-free, which is critical for global shipping.
The energy market dynamics are certainly complex right now. What about the broader corporate earnings picture? Are you seeing any particular patterns emerging?
Yes, and this is actually quite encouraging. MarketWatch is reporting that an earnings boom is around the corner, which could catch bearish investors off guard. We're starting to see companies beat expectations, though it's selective. Simply Good Foods, for example, beat earnings by 4 cents, but revenue fell short of estimates, which shows that beating on the bottom line doesn't always mean top-line growth is there. The war-driven production disruptions are expected to hit major oil companies like ExxonMobil and Shell in the first quarter, so we need to be prepared for some weakness in that sector's earnings. What's interesting is the sector rotation we're seeing. As people lose weight on GLP-1 medications, retailers are starting to see an uptick in business as millions refresh their wardrobes, which is a secondary effect of the weight loss drug trend that many investors haven't fully priced in. The consumer is still spending, but it's becoming more selective about where those dollars go.
That selectivity is definitely going to be key going forward. Steve, let's get into the economic numbers. What's the picture looking like with today's data releases?
Thanks, Robert. Earlier this week, we got durable goods orders on Monday, which came in at 1.4%, well above the forecast of 0.5% and matching the previous reading of 0.5%. That was a positive signal for manufacturing demand. Today, we have three significant releases that markets are watching closely. First, we're getting the Gross Domestic Product Report, which is one of the most comprehensive measures of economic growth. The previous reading was 4.4%, and this will give us a clear picture of how the economy performed in the first quarter. Second, and perhaps most important for Fed policy, is the Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred inflation gauge. The forecast is 0.4%, matching the previous reading of 0.4%. This measures price changes across consumer goods and services, and any deviation from expectations could significantly impact Fed policy expectations. If we see inflation running hotter than expected, it could delay any potential rate cuts, while cooler inflation would give the Fed more flexibility. Third, we have initial jobless claims with a forecast of 210,000, up from the previous 202,000. This measures the number of people filing for unemployment benefits for the first time, and an increase here would suggest some softening in the labor market, which the Fed would likely view as progress toward their dual mandate of maximum employment and price stability.
Those are critical data points, especially the PCE given the Fed's focus on inflation. What's coming up later this week that we should be watching?
Tomorrow is going to be particularly busy with four important releases. The Consumer Price Index is the headline event, with a forecast of 330.4, up from the previous reading of 326.79. This is the broadest measure of consumer inflation and typically generates significant market volatility. We're also getting the Consumer Confidence Index with a forecast of 52. down from the previous 53.3, which would indicate consumers are becoming slightly less optimistic about economic conditions. The University of Michigan Consumer Sentiment Index is also due out with a forecast of 52, down from 53.3, which would confirm the trend of declining consumer confidence. Finally, factory orders are expected at 0.1%, matching the previous reading of 0.1%. These consumer sentiment indicators are particularly important right now because they give us insight into whether households are pulling back on spending amid ongoing inflation concerns and geopolitical uncertainty. If we see significant deterioration in confidence, it could signal softer consumer spending ahead, which would have implications for GDP growth in the second quarter.
That's a packed economic calendar. The consumer sentiment readings will be particularly telling, given all the crosscurrents in the economy. Lizzie, let's shift to crypto. What are you seeing in the digital asset markets?
The crypto market is showing some interesting dynamics right now. Bitcoin has been demonstrating notable resilience, recently topping $72,000 with 280 million in short liquidations, which shows bears got caught on the wrong side of that move. Morgan Stanley just launched a Bitcoin ETF that drew $34 million in first-day inflows, which adds to the institutional adoption narrative. What's particularly interesting from a technical perspective is that on-chain data shows 850,000 Bitcoin were accumulated between $60,000 and $70,000, and analysts are calling this the cycle's strongest demand zone. Michael Saylor came out saying he believes Bitcoin has likely bottomed near $60,000, and Binance data is showing a surge in aggressive buying. However, the rally is turning more cautious due to macro risks, particularly around the Iran ceasefire situation. If Bitcoin can hold above 70,000, analysts are eyeing 90,000 as the next major target. There's been some discussion about quantum computing threats to Bitcoin, but Bernstein put out research saying the quantum threat is real but manageable, and Bitcoin has 3 to 5 years to prepare for that risk, so it's not an immediate concern. Ethereum is in a more neutral position right now. The Ethereum Foundation swapped 5,000 ETH into stablecoins for operational and grant funding, which some interpreted as a cautious signal. ETH dropped along with the broader market as the Iran ceasefire enthusiasm faded, and it's likely to continue trading in tandem with Bitcoin in the near term. Solana is similarly positioned in neutral territory, moving with the broader crypto market trends without any major Solana-specific catalysts right now.
The institutional adoption story with Bitcoin continues to build. What's your sense of where institutional versus retail interest stands right now?
It's actually quite bifurcated. On the institutional side, we're seeing steady accumulation and growing infrastructure. JP Morgan noted that Michael Saylor's strategy is practically the only thing keeping crypto flows alive right now, which shows how important that institutional buying has been. Standard Chartered is reportedly planning to absorb Zodia custody into its investment bank, which is part of a broader crypto custody consolidation trend. Morgan Stanley's entry into the Bitcoin ETF space, even though it's smaller than BlackRock's flows, signals that major Wall Street firms are building out their crypto offerings. On the retail side, sentiment is more mixed. We saw Bitcoin fade from 3-week highs as the Iran war ceasefire news wore off, which suggests retail traders are more reactive to short-term news flow. The liquidation data showing 280 million in shorts getting squeezed tells us there's still significant speculative positioning in the market. What's encouraging is that accumulation pattern between $60,000 and $70,000, because that suggests smart money is building positions in that range and viewing it as a value zone. For the week ahead, I'd say Bitcoin is cautiously bullish if it can hold above 70,000, Ethereum is neutral and will likely follow Bitcoin's lead, and Solana is similarly positioned to move with the broader market. The key risk factors to watch are macroeconomic data, particularly tomorrow's CPI number, and any developments on the Iran ceasefire front.
Well, that gives us a comprehensive picture of where markets stand as we head into the rest of the week. Thanks to both Lizzie and Steve for breaking down these complex dynamics. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you don't miss our daily market analysis. We'll be back tomorrow to cover that critical CPI release and much more. I'm Robert, and this has been the Morning Bell.